If you want to profit from earnings, then you must know the Cinderella strategy. And the Cinderella strategy is the framework for finding out which earnings surprises you should focus on and how you can play this game. So, in order to understand the Cinderella strategy, you have to understand that whenever earnings come out, stocks react either positively or negatively to earnings. So, in this earnings season, if you've seen, some of the stocks have reacted negatively to earnings surprises to the downside. Like Facebook is one example of that, or like say PayPal is an example of that, or if you see Fastly. Is something which is a example of stock which reacted negatively to earnings, and some stocks react positively. So if you look at Bill, it reacted positively, or if you look at Docs, it reacted positively, or if you look at SRTS, which has reacted positively to earnings, so it has been up 20% since earnings or 30% since earnings. So if you want to profit from this particular earnings phenomena or earnings episodic pivot, then you need to understand this entire concept of called Cinderella strategy. And the Cinderella strategy is basically was coined by Richard Bernstein, who wrote a book about style investing, and in this he talks about this Cinderella strategy. And in order to understand the Cinderella strategy by Richard Bernstein, what you need to understand is that basically this is the conceptual framework for the Cinderella strategy. So if you try and understand this particular thing, what it says is that you have growth here, right? So here you have growth, and so stocks which are having growing now, if they miss an earnings, a miss in a earning is what is called as a torpedo. So in this case, if a stock misses an earnings, okay, typically it's not just one time it keep missing earnings. If you look at like say a stock like Fastly, it's not the first time it has missed earnings, right? It has been missing earnings, and that's why the stock has been going down, right? And there's a positive earnings surprise here. Stock made 250% move. After that, it has been missing earnings, and as a result, it is going down, right? So when a company misses earnings, then it starts going down, and typically when a company misses earnings, if it is a fundamental problem in their business or there is some problem, then it keeps missing the earnings, and as a result it keeps falling, and at some stage it becomes neglected stock. That means nobody pays attention to this particular stock, or it becomes completely neglected as a stock. And then contrarian investors, or the people who focus on these beaten down stocks, or the one who are value investors, these kind of people start sniffing around at these stocks, and then a turnaround happens, or the stock has a positive surprise. And when the stock has a positive surprise, then you will see that the stock starts moving. In order to understand this better, let's look at one example of FCX. Right, if you see FCX on a long-term chart, it was going nowhere, right? Or it was going down. Because why was it going down? Because it was missing earnings, right? And then what happened was that it started beating earnings, and as a result of that, earning surprises, it went up 448%, right? And so that this is a very common thing which you'll see. Stocks missing earnings, or like stocks going down, and then some turnaround happens or something happens, and then there is a first positive earning surprise. So this is the first positive, and then it will continue to have continuous positive earning surprises, or it will have a growth, and as a result it will start showing EPS momentum. Now if you look at this particular earning expectation cycle, what you will see is that it's like a clock of a face of a clock. And if you mark there, the basically the, so this is 12 o'clock, right? This is 3 o'clock, this is 6 o'clock, right? This is 9 o'clock, and then it's 12 o'clock. So you can divide this into 4 quadrants basically, and try and understand each of the quadrants. specific trading opportunities. So when a stock misses earnings for the first time, a lot of people go and start buying that stock, and it doesn't work. Why doesn't it work? Because the first earning surprise is typically followed by another one, another one, and another one. So, like Facebook has missed an earnings, it is likely that it will continue to miss earnings till something drastically changes in his business, right? And this is very common in a lot of high flying stocks. Like the first time they miss earnings, people say, oh, this is just one quarter. If you remember, there was a stock called RIM, Research in Motion. It missed earnings for the first time. People say, oh, it's just temporary. And then it kept missing earnings, kept missing earnings. And then finally, like after many years, it has still not turned around. So when companies start missing, they get torpedoed, or they are like, and start leaking waters, or like, they basically start going down, and then they keep. Now, if you want to buy stocks near the bottom, or you want beaten down stocks, then you don't buy after a first earning surprise. After like multiple earning surprise, let's take an example, hypothetical example of a Facebook. Say if there are multiple earning surprises, to the downside, then what will happen is that the management will start taking some actions, or like say you might get a new CEO, or there might be some sort of a cost cutting, or some sort of a spin off, or things like that, or some drastic action will be required for it to turn around. If that doesn't happen, obviously it can keep going down, right? So you have people who don't understand negative surprises can lead to more negative surprises. If they keep buying stocks because it has missed earnings, then in this particular quadrant, it is likely that it is going to keep on going down. And this is what you'll see on many stocks, that they miss earnings for the first time. Like Fastly is a good example of that. And then it misses second time, and it misses third time. So now, inverse of this, or the other side of this, is the first time a stock has an earning surprise. First time it has an earning surprise. When it has a first time earning surprise, that is what I look for, which is an EP, episodic pivot, as a strategy, right? And the first time earning surprise, and there has been neglect for many years, the stock has been doing nothing. For many years, the stock has been doing absolutely nothing, and it's been washed out. Sellers have given up on that stock, or like the buyers have given up on that stock. Everything is down, and then you get an EP. Then there is a positive earning surprise, plus there is a lot of neglect. So as a result, it just goes up very fast. It goes up very fast. And that's the whole idea behind this EP, or episodic pivot earnings based strategy. That's why if you see the examples which I talked about, or the way I made money using this strategy, is basically I find really, really neglected stocks, and those are the stocks which work best for this particular strategy. Now, supposing the company beats earnings, and it keeps beating earnings. So it has one positive earning surprise, second, third. Then what happens is that it builds earnings momentum, right? And this is what will happen, earnings momentum. Now, if you know about IBD, you heard about IBD. Now, IBD has a ratings which is called as a EPS rating, right? That EPS rating is essentially a EPS momentum rating. So what it looks for is, it looks for a stock which has, like, say, the EPS rating is based on 6 quarters of earnings, right? So 6 quarters of earnings, and it is a weighted average of 6 quarters of earnings. If a stock will have 6 quarters of positive earnings, right, in growth terms, then it will be ranked higher. Now, this is the quadrant where you will have, typically a stock will have a high EPS rating, right? So it will have a high EPS rating, and it will also have, because by that time the stock has had multiple earning surprises, so the stock will also have higher relative strength, right? And as a result, most of the IBD kind of investors, they focus on this quadrant, which is 9 to 12 quadrant. So they are looking for stocks which already have earnings surprises, or they have earnings growth for 4 to 6 quarters, and they have earnings momentum, and then the stock starts going up, because as the market discovers a stock which has earnings momentum, it just drives that stock higher and higher and higher. But at some stage, the stock is going to miss earnings, because growth cannot continue forever. And many times the market can also anticipate that the growth is going to slow down, right? Now, the strategy is called Cinderella strategy for a reason, that Cinderella had a very specific instruction saying that, "Okay, look, Anna, these shoes are going to turn into dust after 12 midnight, right?" Similarly, when you are investing in a growth stock, at some stage, the stock is going to turn into a dust. Now, the trick is to trade it between 6 o'clock to 12 o'clock and get out before it is 12 o'clock. So this is something which a lot of time people don't understand or appreciate. And as a result, when you see a list of stocks by IBD and they have high EPS ratings, or they are like that may be that the stock is here. That's why it has very high EPS rating, right? So it might be at 11 o'clock. It might be at 11:30. That's why you'll see many times IBD adds a stock to IBD 50 or some of their list. And then that stock torpedoes, because by that time the stock has been going up. It had multiple earning surprises, it had built earning momentum. And if you understand businesses, not every businesses can continue to have earnings momentum for 12, 14, 15, 20, 25 quarters. Those are rare cases where those stocks had continued to grow for 20, 25, or 30 quarters, typically 6, 7 quarters. A competition can come in, or many factors can change, and as a result, the company can start missing earnings. And the moment it starts missing earnings, then it starts going down. So if you understand the Cinderella strategy, essentially the essence of Cinderella strategy is that you avoid this period, right? Because this is the period where there is a negative earning surprise. But this is where most of the investors or most of the amateurs focus on, because they think that the stock has fallen down. It has fallen down 50%, so it should come back, or like something. But it takes long time. This can be 3 to 5 years in many cases. Sometimes this can be even more than 10 years before the stock will fix its business and it will start coming back. So if you want to make money, listen to the advice which was given to Cinderella, which is like basically the party starts at around, this is 6 o'clock, right? The party starts at around middle of this 6 o'clock and 9 o'clock. So the party starts at around 8 o'clock, right? And that's where you should be. The first positive earning surprise after the stock had series of negative earning surprise, it becomes a neglected stock. You are going to get the maximum benefit. If you're looking for making big money on episodic pivot, you need to find those which are just having a first or a second earning surprise, right? By the time they are fourth, fifth earning surprise, everybody and their mother-in-law and their brother-in-law knows about that stock. Even the grandmas in Florida know about the stock. And when the grandmas in Florida know about the stock, it's 11 o'clock, it's 11:30, or it's 12 o'clock. And this is a classic mistake which you can make as a growth investor if you don't understand the Cinderella strategy. So the IBD kind of investors who basically use the kind of ratings which is like EPS rating above 85 or things like that, you will see that, and relative strength rating above 85, because the stock here is neglected and it has an earning surprise. As a result of that, the stock will have price momentum also, because if there's an earnings and the earning was a surprise, buyers start buying and more buyers start buying, and as a result it builds relative strength. And when it builds relative strength, the second leg, or 9 to 12, is really where the IBD kind of investors or many growth investors. IBD is just an example of like a methodology which is very popular amongst retail traders. That's why. But the trick then, if you're going to trade IBD, is to make sure that you are operating in the quadrant of 9 to at best 11 o'clock. That means like you are not becoming extremely bullish, When the stock has already had very high EPS rating and relative strength rating that has gone up already a multiple percent, that is when you should be most worried about, because that's when the party is going to get over, right? Party gets over at 12 o'clock. And in case the stock misses earnings, trying to buy a stock which misses earnings is going to be, because you don't know whether that earnings is one time miss or it is going to be a continuous miss. Many times businesses miss earnings because something has gone wrong or competition has come in. Like in the case of Facebook, the ground below Facebook has shifted, with TikTok becoming more popular, Snap becoming more popular. So it may not be the first negative earnings surprise. And as they say about earning surprises are like cockroaches. So if you get one positive earning surprise, if you find one cockroach, more likely that you have more cockroaches. So if you find one cockroach, the earning surprise, more likely that there are going to be multiple earning surprise. Similarly, if there is one miss, there are more cockroaches, so it might have more cockroaches. So from a safest point of view, for a retail investor, what you need to understand is that the contrarian investors and all, they have very long period of investment, or their horizon is very long. But your best bet is to wait for a first earning surprise, and once there is first earning surprise is when you should get in, and that is where EP comes in as a strategy. And subsequently the stock starts going up, it will have a earnings, like it will have a price momentum, and that is where momentum based strategies come in. It will rise, the stock will rise, and this is where the stock will show up in your momentum kind of ranking. And this is where you should focus on, like the essentially, if you understand the Cinderella strategy, your best option is to focus on this particular time period, where like around 8 o'clock to this particular time period, and then you will find that that's the best thing. So practically, if you're looking at it, finding the first earning surprise or EP is very profitable. Second, third will be more profitable. As the company keeps on growing, at some stage it might be the one where like you're thinking, look, it will continue to grow. That is where you need to be most worried about, and that is where you need to have an exit, or you need to be cognizant that this earnings will not going to be, and under any cost you should not be getting into a stock which has a torpedo. That means if it has a negative earning surplus, that's definitely your sign that you should get out of it. There are a lot of people who bought like Facebook at the right time, they're still holding. And for them, missing an earnings is a big signal which should tell you that it's time to get out of this party. So if you want to be a successful trader using earnings as your strategy, you have and try and understand this Cinderella strategy. Many years ago, I wrote an article about this on my public blog. You can read about it, the Cinderella strategy, earning season, and the Cinderella strategy, and it explains in much more detail this entire thing with the earnings expectation cycle. So 12 to 3, what happens, 3 to 6, what happens, 6 to 9, what happens, 9 to 12. This is primarily where the IBD focuses. This is IBD focus. If you're classical IBD, clan slim type of a trader, if you want to trade EP, then this is where you want to be, like, you see, this is the article which I wrote. And in this article, I talk about basically the earnings expectation cycle and the Cinderella strategy. You can see this is a free article on my blog, earning season and Cinderella strategy. And in this, if you see, the 12 to 3, 3 to 6, 6 to 9, and this is where the 6 to 9 is where the EP strategy works basically, because you want to be getting into growth stocks as early as possible. So on the date of first earnings, you're trying to enter. IBD primarily operates in this particular quadrant. So IBD's quadrant is this particular quadrant, 9 to 12. And the danger of this is, like, many times you don't know whether it is 11 o'clock or whether it is 11:30 or whether it is just about midnight when a stock has high EPS rating. And that is why you'll see that many of the stocks which have very high EPS ratings don't make good investment, because by the time the high EPS rating has been established, it's time for the party to be over. So learn about this Cinderella strategy if you want to make money from episodic pivot or even from an IBD strategy, having detailed understanding will help you.